Hi there, traders. This is Brad Gilbert with today's trading action. All right, now a few things to cover. The UK election looks like the Labor Party is going to sweep into power with a broad majority, right? But you know what? A change of government generally doesn't mean much. Most of the political parties these days, their policies are very close. So unless we see something like Donald Trump, who came out and just made up policy instantly every other day of the week, it's sort of business as usual. So don't get too caught up around thinking, yeah, I'm going to get on to Sterling and do some stuff, because there's nothing really there. Now, just on a news sort of perspective, a page like this can give us a bit of information on things. The ECB accounts show worries about stalling disinflation, right? So that's when you said, what does that mean for us? Well, when you're looking at euro or euro crosses, as the dollar weakness kicks in, euro will probably just trail a bit behind the other pairs. Now, let's just look at the markets, right? Now, we do have non-farm payrolls, US non-farm payrolls coming out today. The US Treasuries, well, it's like the market is stalled completely, right? And this is the same across the global markets. A bit of toing and froing there on the equity markets, US equity futures, and that's leaving a bit of sideways trading on the major currency pairs, right? And you might be sort of thinking, what's going on? Well, it all comes down to the non-farm payrolls. And I'll come into this because we're at a critical stage for the US data. Now, just looking at the on the hourly charts on the major currencies, okay, the dollar index, it is tracking lower, right? Everything points to a weaker dollar. It just comes down to today's trading and the US non-farm payrolls. Now, it's sort of such a big build-up. I think it's going to be really explosive and probably hard to trade. Especially using pending orders of any sort of description. Now, what are we seeing in the markets? Well, euro is going up, right? If the dollar's going down, which it is, okay, dollar yen is even starting to drift. This is a great time for the BOJ to now stick their head up, right? Because if we get weak non-farm payrolls, and that follows weaker US CPI, weaker US PCE price index, weaker retail sales, everything's weak in the States now, finally. This is the time the BOJ can actually get bang for their buck and really give dollar yen a push to the downside. Now, you've got dollar CAD tracking lower with like a bit of a double whammy here, right? Weaker US dollar, and you've got stronger oil, right? Oil's at $84, and that is really like a double push to the downside for dollar CAD. Sterling up. I think the Labor change of government to the Labor Party is a positive. I think we don't see sterling take off, but I wanted to sort of give you a bit of scope here. This is probably the interim target, 128.50. Aussie's going up, but making hard work of it, as is the Kiwi, right? So what we're getting across these markets is uniformity, and that should give you confidence because we are very close to starting a new trend in the market. Now, with the dollar index, there's a bit of work to do. I mean, I've got this sort of trend channel here, but really, support is down around 103. We really needed to sort of start honking down through there to really get this weak dollar trend in play. Okay, now euro up to above 109, sterling up about around 128, sort of 40, and Aussie is sort of already breaking higher. Don't forget, interest rate differentials matter. The Aussie, the central bank, the RBA are on hold for an extended period of time. Stronger retail sales, stronger data. Right, so the Aussie should do better on the crosses than most, and we should start to see it elevate. But on these daily charts, I mean, we've really got this support trend line down here around 134. Dollar CAD has broken down, but it's hugely overdone, and that's part of Hurricane Beryl, okay, pushing the price of oil up. Dollar yen just sitting in that channel itself, and dollar Swiss in the middle of the range. So when it comes to looking at the daily charts, right, it's a different story to the hourly charts. This is where the action is, and this is where the aggressive price action movements are, and you can sort of see what's happening on the dollar. But when you come over, it's a bit more of a placid sit back and have a look around on the daily charts, right? If anything, dollar CAD's sort of breaking down, Aussie's breaking up. The rest of the instruments, okay, I know dollar yen's just trading up, but the rest of them are all sort of mid-range, right? So what do we do with this non-farm payrolls? This is the big question, because to me, it's the last piece of the puzzle for for the Fed, right? They have told us inflation is important. Inflation's dropping. They've also told us employment numbers are important. So let's just have a look at the non-farm payrolls. We've got a couple of things to consider here. Now, the Reuters poll, okay, 190K. Now, the minimum maximum range, very important, 140 to 250, right? Ideally, to get this dollar trending lower, we want a number below the minimum, 140, right? That would put the cat amongst the pigeons. And of course, when it comes to the unemployment rate, the other sort of key data release, so there's two predominant numbers here. I know there's about 6 of them coming out, but these are the two which dominate. If we get a unemployment rate above 4.1 and a non-farm payroll below 140, so above 4.1, below 140, we've got a big dollar move on, right? So don't forget, there's about 6 or 7 different variables here. Some can be stronger, some can be weak. It really depends on these two, okay? If these two line up weak or strong, both weak, we get a big move. Now, the biggest move for me will be because it changes like stronger numbers here just keeps the Fed on hold. Weaker numbers pushes the Fed into, you know what, cutting sooner than later. I don't want to confuse you there. So that's the key to this, right? 190K expected, right? We were looking for a number below 140 and we're looking for an unemployment rate above 4.1. That is our ideal scenario, right? That's what we're sort of going to look for. And then when you're looking at the other numbers as they come out, yeah, sure, have a look. Average earnings and these sorts of things can sort of fit in. If they're also weaker when these other two numbers are weaker, well, it adds to the story. But so with the way the economic numbers have rolled, right, we've got a situation where this could be too powerful a move for liquidity to sort of allow you to sort of transact smoothly. Now, let's just have a look at the non-farm payrolls, the number itself, right? So the poll, 190,000. Now, Smart Economics is suggesting, and this Smart Economics is the previous people who got it right, they are expecting a slightly higher number. But have a look every time we've seen a peak, like it bounces up, we see a direct snap back down, okay? And this is pretty common across the board, as we've seen over the last sort of year, okay? And you know what? We've got that sort of snap back here from 170,000 up to 272. It's sort of, you got to think, right? Logic, or not logic, maybe just guessing, but we could see a correction back down. Now, 140, I've seen some bizarre numbers on the non-farm payrolls over the years. Don't discount anything, but you're sort of looking for trends in the data. The unemployment rate, let's just have a quick look at that. The poll, 4%, right? Pretty tight sort of numbers, but check this data out. It is trending up, okay? So and I guess actually in the same sort of passion here, every time you see a decent spike, it sort of corrects itself up again, down, up. So maybe, you know what, if I was being sensible and consistent, we might see a slightly better unemployment rate, but really our best outcome is for above 4.1, right? Really puts as I said, the cat amongst the pigeons, really lines up weak CPI, weak employment, Fed, let's go to work, right? That's what I'm really focusing on. Now, outside of that, now this is the disappointing part of every second month, is we get the Canadian employment numbers at the same time, right? If anything, when that happens, the Canadian numbers just get pushed aside, right? The traders in Canada, and I worked for one of the Canadian banks for a few years, that's their focus, right? But the global market will be looking at the non-farm payrolls. So, you know what? Keep a track of the employment numbers in Canada. But what you're going to get is extremely violent price action here, right? So if we get weaker numbers, so a number below 140 and above 4.1, you got to sort of think about and hypothesize what's going to happen here to the price action. Well, the dollar is going to sort of melt down, right? So when you're looking at your charts, whether it's the hourly charts, I'd be sort of having a look at your daily charts and sort of thinking, well, This is big, right? This will be the big start of a US dollar downtrend. Now, this is where you got to put everything together. Now, euro, we've got a geopolitical situation there, around this French election. And, the ECB have sort of mentioned in their meeting accounts that they're worried about disinflation and a whole range of things, right? So they got their hands full. Now, UK just had an election, new government, positive outcome. This, to me, looks like a better entry level. And I can see, and predominantly what I'm looking for at the moment around this number is a trend line that's at least 50 points away. And you might think that's bizarre, but if we get really weak numbers, I would expect the move to be at least 150 points, right? A move down in the dollar, 150 at least, right? So I'm looking for areas where I can get some liquidity, right? So if I want to buy, I buy where there's trend lines because that's where the liquidity is, right? So sterling to me, that's like 80 points away. But let's just sort of see where it is when we get a little bit closer to the action. And like some of these instruments, weak US numbers, it's going to be tricky, right? Aussie, there's no resistance up here. Kiwi, maybe. I just don't like trading the Kiwi a lot because it's got really thin liquidity. Sterling's a goer. Dollar Swiss, I like this one, right? Things just saving there, the file. Let me just have a look where that level is there. 188.78, 120 points away, right? Bit of a stretch. So then you can come back into your hourly charts and sort of really piece together what happens. Like to me, I'm not putting all my eggs into one basket. I'm putting my eggs where they should fit, and it's a weaker number. And dollar Swiss, no levels on the downside. That's going to be tricky. Dollar index, nothing there. We've got a level here, 108.20-ish on euro. That's going to blast through there. So that's not going to help us too much. Once again, you're coming back to sterling. Aussie's got nothing. Kiwi, nothing. Dollar CAD's got nothing. This is why you could get an explosive move. I also think dollar yen might be the time to tap into the beast, right? And that's at 160.107. That's pretty close, right? I wouldn't be surprised. I'd say out of everything, dollar yen might be our choice of instrument here, sterling and dollar yen. But that's what you need to be considering as we come in to these numbers. All right, and that's pretty much it. It's this is the big game. It's the showtime, and you know what? You've really got to focus in on what's happening. I'll post these rates into the Discord so you can actually find the release data there, and hopefully that sort of helps you put it together. But anyway, I think the liquidity around this event, if we do get numbers lining up, what you want to do is you can actually almost sit back and just have a look at the numbers, see what happens to the yields, right? Weaker US non-farm payrolls should push the US Treasury yields down. Equity markets will shoot up through the roof, and you'll see Euro, Sterling, Aussie, Kiwi up, and the dollar down across the board. That's what you're going to expect. All right, guys. Pretty big day in the scheme of things. We get stronger non-farms. It's going to suck because all the other numbers have been weaker. In fact, our actual ideal scenario here, and I know I was just focusing there on really weak numbers, but what would be better is a number that's not below 140, say, but below 190, a number around 170, and maybe just 4.1, like right on the edge here. It's only 0.1 difference, but what that would do is it would make for a smoother data release afterwards, right? If we get a savage correction here below 140 and above 4.1, right, we're going to see gapping, slippage all over the place. So don't think a number like 170, 160, 170 here, even 4%, right? That's as expected, but this number here is weaker. That'll be enough to get the dollar falling, and it will be an orderly price action. That's probably our best outcome. Extreme variance is not our friend in this situation, especially if you're using pending orders. All right, guys, that's a bit of a rundown from me. I'll be watching closely to see how this plays out. All right, guys, have a good one. All the best. Cheerio.